Banks don't reject your mortgage application because you're self-employed. They reject you because you don't know how to speak their language. There's a famous saying, knowledge is power, and the same applies for when you're self-employed. And all your mortgage rejections by having the right knowledge and by working with the right lenders. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of Broker of the Year, top originator across the country, and I've worked with oodles and oodles of self-employed clients and entrepreneurs to help them amass real estate riches. Story time, folks. One time I was playing Fortnite. I actually just saved one of my most recent self-employed entrepreneur clients hundreds of thousands of dollars with wasn't even a hack. It was such a simple scenario and idea for them from a mortgage perspective. And they were originally going down a really aggressively expensive path, and we're able to kind of dissect what a better move was. So for instance, with this self-employed client, they were going to do a full doc loan. What does that mean? They were doing a conventional mortgage. They were going to show all of their revenue as profit and not write off for 1 year a lot of their expenses. Because again, if you remember from all my YouTube videos, if you are self-employed and get a conventional Fannie or Freddie loan, if your business open over 5 years, you can do a 1 year average. So for 1 year, this client, who's an entrepreneur, was killing it, decided, hey, I'm not going to take off all my allowed expenses. I'm going to show the IRS a high profit because vis-a-vis showing that to the IRS, of course, and file returns, you're showing that to the lender, to the underwriting team, and that higher amount of profit divided by 12, which is a year, is going to give me enough for me to qualify. Now, here's the catch. If you show millions of dollars a year in revenue and you write off just enough expenses to get down to, call it, $1 million net profit, that $1 million net profit, about $80,000 a month, that's good for a mortgage, of course, or at least, in their scenario, a couple $1 million house, they put down about $1 million, $1 million loan, $600,000 mortgage payment, call it a $9,000, $10,000 monthly mortgage payment, of course, $80,000 a month. That's going to get the job done, even though it seems like they were, underfiling their expenses. The problem is if you show a net profit of $1 million, you're paying hundreds. That's right, folks. That was an S. Hundreds of thousands of dollars of unneeded monies to the IRS in terms of amount you owe them for income taxes, right? So not only to the state, we weren't even talking about the state at this point, we're just talking about the feds. They were going to pay hundreds of thousands of dollars to the feds, to the IRS, for the amount owed for their taxes when they didn't realize, think about it, to qualify for the mortgage, they would have qualified for a bank statement program all day long. They didn't like the bank statement program because the interest rate was 0.5% higher. So instead of doing the conventional loan with a 0.5% better in rate, paying hundreds of thousands of dollars to the IRS in taxes owed on their income tax, we did a bank statement program. Yes, the rate was 0.5% higher, but it actually wasn't 0.5% higher. For every 1% in discount points, 1% fee off the loan amount, we got them a quarter better in rate. So 2% off the loan got them a 0.5% better in rate. So follow me. $1 million loan, 1% of that $1 million loan is $10,000. 2% of that is $20,000. $20,000 sounds like a big closing cost versus, paying no points, right? Most people want to pay no points when it comes to mortgage. Now, if you think about it, if the going rate on the conventional loan that they were going to get, filing not that many expenses, but a huge profit, they were going to owe hundreds of thousands of dollars for no reason. That rate was 6.5%, and the bank statement program was 7%. Imagine we owed the IRS nothing because they kept their expenses to what they had been, which is the legal allowed amounts, I'm sure. And instead of now paying the IRS literally, I think it was like $280,000 they were about to stroke a check. Like, who does that? Now you're paying $20,000 for the same rate. So think about it. You're paying $20,000 to get that same rate if that rate's important to you, and you saved that 280 minus 22. It was a $260,000 swing. So I was able to swoop in before this client had their CPA, press the send button, stroke a massive check, and show them that you're just being put into the wrong mortgage. They walked into a big bank. That big bank didn't offer non-QM. They got wind of it, on social media, let alone my amazing YouTube videos. We spoke. We went over the 12 months bank statements, and we showed them instead of, filing your returns and not taking your allowed expenses, we're going to save you all this money and get you the same great interest rate. But I hear all the haters now, Andrew, it's not as easy as that. If I file all these expenses, you're never going to qualify. Like, it just sounds shady. It's not true, guys. It's just not true. Remember, he who has the money makes the rules. Who has the money the lender and those that are funding the loans. And the rules typically for conventional mortgages for FHA, we look at tax returns and we go off of the net, right, on a tax return. That's how we ascertain or figure out, big SAT word, I know, guys, the income on a self-employed client, right, as it relates to someone self-employed. A lot of moving parts there. They created these cool new mortgages, these non-QM mortgages. They created these mortgages that are based off the cash flow coming in. And I get asked all the time, hey, Andrew, I have $100,000 in deposits, but I only leave about $1,000 in the account every month. That's perfect. Doesn't matter. They don't look at expenses or the money's coming out. It's how much revenue is coming in every single month. There's nothing shady about it. He or she who has the money is making the rules and said, you know what, we don't want tax returns. We want a higher down payment and great credit profile, but we're going to look at bank statements. I promise you guys, nothing shady about this. It's just, again, he or she who has the money does in fact make the rules, and they've decided the way they're going to figure out income for self-employed is just going to be different from what the norm is. Or I could hear you now, hey, Andrew, you know, I'm typically always getting the answer no. I've had it. Well, I question you, or I challenge you with this. You ever ask someone on a date? Maybe that person said no. It even happened to me once, if we're being forthcoming here. Did you quit at the first try? No. Even tried 2, 3, 4, 5. Maybe, like me, you had braces in middle school and you were awkward. But regardless, you never give up at, try 1, 2, or 3. So it's the same thing here. Some lenders just don't offer these new amazing programs, non-QM loans, P&L or bank statement backed loans. You don't give up when you get that first, second no. So if you're in that situation now, so if you've been told no, I can pretty much guarantee you, if you're self-employed and entrepreneur, you're just not speaking to the right companies, and you never give up. And of course, hey, Andrew, it's so much more expensive to get these loans. No, I actually just showed you it would be way more expensive if you paid the IRS all this tax money owed just so you show a higher profit versus getting these bank statement loans, maybe buying down the rate a little bit with a couple points, save yourself 0.5% in interest over the life of the loan. It's by far cheaper for you to do these non-QM loans. It just has to be presented to you in a better way. And you have to see the full picture because, again, right now, if you're self-employed or an entrepreneur, you definitely have a huge stranglehold on the marketplace because most that I've worked with have that 20% down. They just feel like they don't qualify because their income is never enough. Now it is. These are exciting times, guys, to live through in the mortgage space because normally, if you were self-employed, there was only one type of income review, depending on the loan type you were getting. There's conventional, which is Fannie and Freddie, there's FHA, there's VA, there's USDA. Wasn't really much stuff outside of that back in the day. Before I even got in the business, there was, stated self-employed, meaning like, hey, how much do you make? And the client would say, and that's what he worked off of. So for such a long time, the self-employed demographic has struggled. So now I say that there's 2 buckets now. One is, and we'll go over the vanilla, we'll call it, right? 2, I want to call it the chocolate. There's nothing wrong with the chocolate. My youngest daughter loves chocolate, right? Nothing wrong with it. But there are now 2 buckets on how we ascertain or figure out income. One, conventional, Fannie, Freddie, or FHA, or VA, like the normal typical vanilla, which we'll go over what they look at very roughly so you guys know. And you can end all these potential issues or declinations self-employed clients are getting, because the second bucket, this is the bucket where you have the non-QM space. We have bank statement review, revenue reviews, P&L, 1099, all that stuff. We'll go over it now. But before we do, guys, make sure you go in the description, click the link, go in the description, click that link. We have our self-employed cheat sheet. There's so much information in there. There's a calculator, there's all this cool stuff that my team has prepared for you, all for free. Make sure you click the link and get it, guys, because there's so much that we get into here. There's never enough time for me to geek out and talk about all this stuff. So at your own time, your own pace, and it's super simple. To keep it simple strategy, make sure you go in the description, click the link, and get our free tools. Non-negotiable. You definitely need it. If you're watching this, it's definitely something you should grab. All right, so the 2 buckets, right? The first one, let's talk about, conventional. Let's talk about FHA. Let's talk about VA. Let's talk about you and me. Not sure that's an appropriate song. All right, so we got conventional over here. And the second, we're going to do more of my favorite, non-QM. So when we're talking conventional, there's so many guides around this, right? Typically, they want 2 years. The business is open. Sometimes you can get away with less as long as they want to see 1 full filed year of tax returns. So again, if you're self-employed, there's oodles and oodles of types of ways that you can file, right? There's a Schedule C. There's an 1120. There's an 1120S. 1065, you have partnership returns. You have all sorts of ways, right? You have K1s. Sometimes you got some W2s. Within all that, they want to make sure that at least one full calendar quarter has elapsed. So right now, let's say it's August of 2025. Now, this year, current year, if you're killing it, if your business opened, last year was a full year, right? So let's say it opened 12 of 23, right? So last year you filed your returns, the full year elapsed, so the lender underwriting team is okay with it. It hasn't been 2 years. There was one full year. Before that, you're in the same line of work. It's still okay, right? That 2-year requirement, you can kind of get away with it if the year before was the same line of work and W-2 and similar income. But say right now this is August, right? So say your Corp Docs show it's been open since August. Say this year to date, you're killing it. We can't use that on these type of mortgages. You're going to have to wait until you file next year for this year's income. Super frustrating. But we'll talk about that a little bit more in a little bit. All right, so Schedule C, sole proprietor, 1120S, 1065. What is the commonality of all these? If you think of a tax return, you think of your revenue. I'm going to make it real simple, guys. Revenue, $1 million. Expenses, all these different forms have different ways that shows the revenue, the expenses, some of the stuff you could write off. A Schedule C is very basic. The 1120S world into the S Corps and the Corps, it gets a little bit more specific and granular. There's more stuff you could write off. There's way more columns and rows, right? So say your expenses over here are $900,000. And not all these are actual expenses. Some are paper expenses, previous losses carried over, put on to the IRS side. You have $900,000. So typically, this would show $100,000 that's left over. Say you give yourself that in the form of a K1. If we look in the expense side, say on the mortgage side, there are some things we could actually add back. So instead of an expense, we add it back like depreciation, things of that sort, one-time expenses. Now, say in this case of expenses, there's nothing we can add back. Unfortunately, when you didn't write off depreciation, that $100,000, this is going to whittle down to about $8,300-ish, just rough, guys. Yes, I'm a math guy. I know how to do math. I'm just keeping it nice and simple, just for the brains out there. So $8,300 a month. This is what it kind of whittles down to-ish of monthly income. Now, unfortunately, many entrepreneurs and self-employed clients that I've worked with that are making $1 million a year in revenue, especially, sole proprietors, one-person owner, type business owners, or 100% owner, in their head, they're making $80,000 a month in revenue. They think they're killing it, and they are. It's fantastic. 2 comma club. Who doesn't say that's fantastic? But whittling that down to $8,300 a month in usable income, assuming that they have great credit and the business pays most of their debt, you're still only going to get credit for about $4,150-ish a month for a mortgage. Now, say taxes and insurance about $2,000 a month, because somebody that makes this type of money is probably looking at, at least in New York, something where $2,000 would include tax and insurance, it's about $2,150 left over. So it's like a $300,000, $400-ish thousand max mortgage. It's just not going to do the job, right? So this has always been the most popular income review type. Depending on conventional, you can get away with a 1-year average if the business is open for 5 years. A lot of moving parts there with a conventional loan, typically a little bit higher of a down payment at times if your credit score is not the best. FHA, VA, the government mortgages, they go a 2-year average. And they made it as of late that if your income, your net profit, year over year goes down over 20%, it's just no bueno, guys. And for those that don't know what no bueno means, it's just not good. Super no bueno. So there's a lot more moving parts here. Just the way that they figure out income is just not ideal. But this has been the go-to, especially since I've been in the business for many, many, many years. So as you can see, this type of client, they're like, you know what, Andrew, I'm not interested in a $500,000 house. I wanted something for $1.5 million. So either I have to save up all the money for a down payment, or I'm just going to keep renting and keep renting. So this, although it's the first and it's doable, the 2 options are either we're going to show this 100,000, guys, right here. We're going to have to cut some of these expenses. Like I said in my example, say we cut 400 off the top and we made this 500,000, right? So if this went down to 500 in expenses, and then the K1 would be 500. That sounds easy, right? Now this person, instead of making $8,300 a month, they make a little over $40,000 a month. Man, wasn't that so simple? I'm a genius. I just figured it out. It actually is not that simple. Because of that, if you show net $100,000 of income after some of the write-offs, you're probably paying about $20,000 in IRS tax obligations. Now that $500,000, it could bring it up substantial. It could bring it up to $100K plus. As we said in the example of our other client, they were paying hundreds of thousands of dollars in IRS debt owed just to qualify for a mortgage. I don't know if that's the best case, right? So again, solutions around some of this stuff is just simply you can't take a lot of expenses. Ideally, do a conventional loan. So for 1 year, you don't write off a lot of your expenses. FHA, VA is a 2-year average, so it's just typically not going to work. But this has been the biggest, or the best illustration of what it's looked like over the last several years to qualify for self-employed. Now here comes our exciting option 2. Of course, shout out to Gabby. All right, so here's our chocolate. In a good way, non-QM, delicious. Obviously, I haven't had breakfast yet. I'm intermittent fasting, so chocolate ice cream, something about that sounds really appealing. So on the non-QM side, let's take an example over here again. So you have this $1 million a year revenue guy. So in the non-QM side, we could talk about 3 things, as we said before. Again, guys, right now, just make sure you stop, go in the description, click the link, get our self-employed analysis, our income calculators, all the good stuff we're giving away for free. We're going to go into this a little bit more, but it's a lot. It's a lot to digest. Make sure right now, I'll take a deep breath. I'll put down my C4 caffeine drink and go in the description, click the link, and make sure you get our free calculators, right? And our free income analysis shows you all the non-QM mortgage types. It's super cool. The $1 million a year in revenue, we're going to talk about this as a 1099. We're going to talk about this as a bank statement program, and we're going to talk about this as a P&L program. So it makes this super cool. Client A, they were going to have to write off so much less in expenses over here, pay so much in IRS tax obligation just to qualify, let's say on a $1.5 million house with 20% down. So that same $1.5 million house, 20 down, is a $1.2 million loan. And again, we're just going to do a super duper rough 7% rate, 7.5% APR, $8,400 a month mortgage payment. Let's say another $2,000 we set it for taxes and insurance. So that's about a $10,400 a month mortgage payment, right? So as you can see, $8,300 a month initially was not even close to getting the job done for this. Now they brought it up to about $40,000 a month. That'll, of course, get the job done. Now you're going to pay all this money to the IRS, which is fine. But let's say the rate of 7% here over here was 6.5%. So to get that rate of 7% down to 6.5%, you pay discount points. So you see a $1.2 million loan, for every 0.25%, typically, 0.25% in rate, you have to pay 1% in fees off the loan, which would be $12,000 to get that quarter lower in rate. So let's say, for instance, that person was hell-bent on getting that 7% to a 6.5%, which they would have got over here, and they have to pay 2%, right? 2% is what it's going to take to lower a quarter for 1%, another quarter in rate for the 2%. So another $12,000. So $24,000 in additional closing costs to get them to the same rate over here. Now, they originally have to pay $100,000 to the feds, at least to the state, at least in New York. This has got to be another $20,000 to $40,000 in additional income taxes just to qualify for the mortgage. So that's a swing of about $100,000, right? So they're originally going to pay no money in points and over $100,000 or so just to qualify for the loan. Now that this goes to nothing, and they pay $24,000 in points. So this program, and there's no catch, guys. It's just how they look at income is just different than the typical programs, the vanilla. So this is a $100,000 out-of-pocket swing to get the same program. It's literally, it's a no-brainer. There's not one reason why you wouldn't do this program. So if you look at these 3 options on how do you actually qualify, the 1099 side, they're going to look at, if you're, again, a 1099 contract, we receive 1099s, say it's 2025 right now. So they're going to look at 3 things. Your year-to-date, how much you're making year-to-date in this 1099 role, 2024, and 2023. Just keep it real simple. What was your 1099 for 23? So, of course, in a perfect world, it was $1 million, $1 million. And then year-to-date, right now it is August. So 7 months of the year-to-date, it's about $560, assuming you'd be making $80,000 a month. So it's a simple calculation. You take your year-to-date, the 2 previous years, you add that all together. So that's going to be about, roughly 2.5. And then we can give you credit for 90% of that. So 10% comes off the top. So from that is what, 2.25-ish. That's what we can give you credit for right out of the gate. That's opposed to doing all this craziness. So that shows instead of doing $100,000 for the year or having to write off less and having a huge IRS tax burden, we can give you credit if you're a 1099, self-employed, business owner, entrepreneur, but you're getting income 1099. 90% of the face value of all of your income we can use right out of the gate. That's option number one. Now, not everyone gets 1099s. If you're a bank statement, if you're someone that gets revenue in your company bank statement and you're not getting 1099s, the way we calculate income is a little bit different. We're going to look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. The last 12 months of your bank statements, and we're going to calculate the incoming revenue in each month. Now, we're going to look for trends. We're not going to see huge volatility. 200,000 one month, 0 the next, 10,000 the next, 0 the next, 300,000. There are ways to get that done, which we're alluding to in the P&L program. But on the bank statement side, they want to see, give or take, within 10 or 20%, very consistent amount of deposits. So let's say that each month you have about $100,000 worth of deposits, right? So 100-ish, 100 all throughout the whole thing. So the way, this is 1099. So if we're doing over here, kind of break this up a little bit, bank statements. So $100,000 a month, guys. Instantly, no questions asked. If you're 100% owner of this business, we will give you credit for half of that for income. So you have $50,000 a month is half of that. It's that simple. They look at your incoming revenue. If you own the business at 100%, cut it in half, just revenue. We don't care about expenses. We don't want any NSFs. We don't want monies overdrawn, so the account has a negative balance. It's a no bueno as well. We talk about what no bueno means, right? $50,000, assuming no debt, you can get up to a $25,000 mortgage, almost half of that. So here's your 10-4 mortgage. This goes to show how you qualify all day long in a bank statement program. Easy enough. And if that doesn't work, right, we were talking over here, the consistency. I've always discussed in previous videos an example of someone who's seasonal. So that, for instance, everybody was working with the company that had the Santa pictures, right? You go in with you and the newborn, Santa, it's beautiful, cool. All of a sudden, social media is flooded, everyone getting the same pictures. That specific business owner who actually was able to work with, they then all started doing Easter pictures. Super cool. Then they started opening up to Valentine's Day and Father's Day and Mother's Day. But regardless, that's like 3-4 specific instances a year that they're opening up their business and getting monies in. So obviously, Christmas is December. They were killing it. Like October, November, part of December, they pretty much sold that as it was. Easter, a month or two before, they were killing it. And then the other, maybe Father's Day, Mother's Day. But there were several months during the year, at least 4 to 6 months during the year, where they had no money coming in because they weren't offering any services. So a lender, if you were doing the bank statement program, if, let's say, December is decent, November, so say like September, an X. Let's say August, an X. Let's say July. Those 3 months, they weren't doing well. They're doing decent in April, decent in March, February, January, a big no, right? And a little bit here and here. So they're going to see all these months of income volatility and discredit that income on a bank statement program. So that's why they created P&L programs. So the P&L program specifically, how it's different than a bank statement program, we don't get the 12 months. We only get the most recent 2 months. And it just shows in the last 12 months, what have they made in revenue, what have been the expenses, and what's the net profit. So the good news is when you add up all this revenue, call it $1 million, they're not going to realize or know that it was only in, call it 8-ish, 7-ish months of the year. So the underwriter will have no issues as long as the last 12 months, that revenue number minus the expenses, let's call this 500 in expenses. So the net profit is 500, and they use that net profit number at 100%. As long as that number, that net number works, that's exactly what they're going to work off. So this shows you guys, most people were living in the vanilla world, option one, where there was just, it wasn't that hard to figure out what you made, but denials were popping out left and right for self-employed clients because they didn't realize if their accountant was good and wrote off what you're allowed to, you're just going to get declined because in your head you made $1 million, but you actually showed the IRS $100,000, it's not going to get the job done. Here comes the world of chocolate, which is amazing. Non-QM has definitely taken this market by storm on the self-employed side. These are just 3 examples. There's more. There's always month over month. These programs are kind of fine-tuning, but a 1099 income mode bank statement or P&L income mode, these are, roughly how they're figured out, but it just shows you how easy it is to qualify just by knowing you're going to the right place, not exactly, trying to fit yourself, square peg, round hole type thing. Some places just straight up don't offer non-QM loans. So when you're inquiring and you're self-employed or a business owner or an entrepreneur, make sure you're inquiring with a mortgage broker company typically who will offer all these program types. And again, guys, make sure you go in the description, click that link, that free tool. We spent a lot of time on it. It's free. You definitely need it. If any of this stuff resonates with you, make sure you get that free tool. All right, guys, now that you've stopped rejection right at its tracks, so make sure you click here and watch our next video, because not all loans are built for all entrepreneurs or self-employed clients or investors. So make sure you click this link and see which mortgage type makes sense for me. I'm self-employed, right? What mortgage should I choose? And I'm self-employed. Make sure you click this link, watch this next video. It's gonna show you all the types that are applicable just for you.